Thank you.
Thank you, Laura, and welcome everyone. Thank you for joining our class tonight. I will share my screen and we can start the presentation. Bear with me for just a moment.
Perfect.
Okay, thank you. Tonight's topics, the mortgage process, what does a lender look for in a borrower? We'll discuss credit reports, credit scores, and tips on how to maintain and improve your credit scores and credit report. How much money will you need for down payment, closing costs, and generally build a roadmap to assist you in buying your first home. There are three key considerations: your ability to repay, willingness to repay, and the value of the property that you're purchasing. So first, let's start with ability to repay. Ability to repay depends on your income, liabilities, monthly payments, debts, and the type of property, single family or multifamily. Multifamily would have rental income that we can use to qualify. There are two key ratios that we use to determine eligibility. One is the housing payment ratio, and the other is the total debt ratio. The housing payment ratio includes the mortgage payment, principal and interest, plus real estate taxes and homeowners insurance, or if it's a condo, the condo fee. So your PITI, housing payment, divided by your gross monthly income is the housing ratio. Ideally, that ratio would be between 28 and 33% of your gross income, although it can be higher and often is higher if a borrower has compensating factors, for example. So we typically see that ratio at a higher level than 28 to 33. That's a target. That's kind of the ideal goal. The total debt ratio is the housing payment, PITI, plus all other debts, car loans, student loans, alimony, child support, minimum monthly credit card payments, total debt divided by gross monthly income. Ideally, that number would be between 36 and 38% of your gross income. And again, it can be higher with compensating factors, and often that number is higher. Willingness to repay. Have you made your payments on time? This is the strength of your credit report. Have you disclosed all debts, including any new loans that you may have applied for just recently that are not on your credit report yet? There's always a lag time for a new account to be reported. So if you've opened up a new credit card or taken a new car loan or car lease, let your loan officer know. Any lines of credit. Often alimony and child support is not it's definitely not listed on a credit report, but it would not be known unless you would have to disclose that. Sometimes it's listed on a pay stub, but in bank statements. But please, that's very important because that will come up through the bank statements. So we need to know any alimony or support payments up front as well. And generally, have you made your loan officer aware of any past problems, credit issues, and that will be helpful so that we can get out in front of any issues and make suggestions on how to repair your credit report if needed, and advise you on how to be in the best position possible. Credit scores. All lenders use FICO scores, credit scores. Scores range between 300 and 850. 760 and above is what's needed to qualify for the best rates. That's for a standard conforming Fannie Mae, Freddie Mac program. With the first-time buyer programs that are available, the minimum credit score is actually lower. But for a standard program, 760 or above will enable you to qualify for the lowest interest rate. Your FICO score is impacted by your credit history, the amount that you owe, the length of your credit history, the number of new accounts, and the mix of accounts. If you have car loans or maybe student loans along with some credit cards, having a mix of different types of debt typically strengthens a credit report, although it's not required, certainly. People have great credit scores, and they might just have a few credit cards and nothing else. So that's generally what we've observed. Some resources to obtain a credit report. The three major credit bureaus, TransUnion, Equifax, and Experian. You can obtain a free credit report through annualcreditreport.com. That is a site that has been established by the credit bureaus. It's a safe site. It's secure. It's the best way to get a free credit report and to monitor your report. If you do see any errors, any incorrect information, you can start the process to have your report amended, or you could dispute anything if something is inaccurate. So that's a great site, annualcreditreport.com. Throughout the report, you'll see links. These are all hyperlinks that you'll be able to use to access these sites and continue your research. And as Laura said, we'll be sending a copy of this presentation, so you'll have all this data, and these links will be available. Always be careful to safeguard your credit. There are definitely steps you can take to protect your credit report. Monitoring is the most important, as I mentioned a minute ago, to make sure that there isn't any fraudulent accounts, that all of the liabilities reported are in fact yours. Always monitor your bank accounts and credit cards for any suspicious activity and flag anything that is suspicious immediately. Let your credit card companies know. You can lock your credit cards if you feel that there may be something going on with the fraudulent situation, and you would do that directly through your credit card provider. You can add a fraud alert to your credit report as well. That will alert creditors that you've been a victim of fraud, and they should contact you before approving a credit application for a new account. That's helpful. There's other information available through the Mass Attorney General's office, as well as the Federal Trade Commission. Next, property value. An independent appraiser will complete an inspection of the property to determine the value of the property. The appraiser is not a home inspector. That's different. We always recommend that you have a home inspector inspect a property to confirm if there are any issues, so that you're not surprised with any repairs or deficiencies or problems later. A home inspection is not required, but it's always recommended. that's an additional cost that you would incur if you were to hire a home inspector. As far as the appraiser does inspect the property, and they determine the value based on the most recent sales in the neighborhood. Uh, they'll find the most comparable properties and they'll make adjustments. Sometimes it's difficult to find a property that's exactly like the subject property, so they'll adjust for square footage and condition and the number of bedrooms and bathrooms and so forth to formulate a value. So it is an opinion, but it's based on recent sales and generally accepted methodology that all appraisers use. So, if you had three appraisals, for example, the values should be all very similar. They may be exact, but they may not be. But they should be within a narrow range. The lender receives a copy of the report, and when your loan is approved or underwriting decision is made, that appraisal will also be provided to you. Cash requirements. Typically, down payment minimums range from 3 to 5% for a single-family home or a condominium. Usually, it's 5% for two-family, although there are 3% down two-family options available. But generally, 3 to 5% is the range for a first-time buyer program. There are programs that have down payment requirements less than 3%, as low as 1% or 0%. So we do offer programs with minimum down payments less than 3%. In addition to the down payment, you'll need funds to cover the closing costs, reserves, if applicable. Some programs, not all, require that we verify that you have at least 2 to 3 months of housing payments in reserve that you're not using to acquire the property, that we verify in your checking, savings, or various accounts that you may have. And again, not all programs require reserves, but some do. Acceptable sources for the down payment and closing costs would be, of course, personal savings, inheritance, funds, gift funds, sale of other financial assets, stocks, bonds, other hard assets, cars, other property, and down payment assistance programs as well, which we'll discuss in more detail. Laura is our expert in down payment assistance and grant programs. So Laura will take this piece of the presentation.
Thank you, Mark. So, as Mark alluded to, there are a lot of down payment programs out there. But I wanted to let you know that East Cambridge Savings Bank is a member of the Federal Home Loan Bank. You have to be a member of the bank to participate in some of these down payment programs. There are 3 of them that I really want to mention that have gone over very, very well over the last few years. One is called Housing Our Workforce, or HOW, and the other was called Equity Builder. You have to be a first-time home buyer. If you qualify the Housing Your Workforce, you can have income up to 120% of median income, and the Equity Builder is 80% or less. You can see that on the Housing Your Workforce, you can get 10% or up to $25,000 in down payment assistance. And with the Equity Builder, you get up to about $30,800. We've made quite a few loans in the past and we're able to access these funds, but I will tell you that as soon as they roll them out, the funds get eaten up right away, because we know that in our market, every little bit helps, especially in the prices of homes in our area. And as Mark alluded to, the hyperlink will take you to the site if you want to learn a little bit more information about it. We can also call Mark or myself or to go over the information. The other loan program, it's called Lift Up Home Ownership. It might be on the next page, and that's another program they rolled out 2 years ago. It's down payment money. You get up to $50,000 if you're first generation to this country, people of color, we were able to grant access to one mortgage borrower that got up to $50,000 in down payment funds. I will tell you right now, there aren't any funds available. I would wait till the beginning of the year. They usually roll them out 2 or 3 times a year. Doesn't mean you still can't look for a home, buy a home, because even if you have a loan in process and the funds become available, if you qualify, we can reserve the funds for you. So the only catch to these is you have to have a purchase and sales agreement. Sometimes timing is everything, but I honestly, if you're working with a lender, if you're working with another lender, find out if they are members of the Federal Home Bank, because these are both great programs. What we also did was we provided you a list of some other down payment programs through various cities and towns. Went to the city of Cambridge, city of Lynn, Newton, Somerville, and they have North Suburban Consortium, what covers Malden, Medford, Arlington, Melrose, Chelsea, Everett, Revere, and Winthrop. I always say, whatever town you're looking in, even if you're just starting out, call the city or town, find out if there are any funds available. Even if there aren't, get the information so the funds roll out, you'll be ready to access the program. I always say it's free money. With the Federal Home Loan Bank funds, if you stay in your house for 5 years, you don't have to pay anything back. You don't have a mortgage payment. It's just a secured second when you take out your home. And if you sell it within the 5 years, the payoff is prorated. Again, I call it free money. And if you can get access to it, and if you qualify, please make every effort or talk to your lender. So if you have any questions, again, these are the hyperlinks. If you want to talk to me on the side or give me a call another time, I'll be able to go through more of the details. And then this is some links for the difference between down payment assistance and grant programs. So I hope you'll find information helpful. That's it, Mark. Turn it back to you.
Thanks, Laura. Next, let's discuss closing costs, which are the fees associated with processing and closing your mortgage. First are the actual closing costs associated with your loan, which would include lender fees, attorney's fees, title insurance, the appraisal, credit report, and the recording fees at the Registry of Deeds. Points are optional additional fees, which we'll talk about in more detail, but generally points are fees that one could pay to reduce the interest rate. Also, prepaid items. The prepaid items separate from closing costs would include the prepaid real estate taxes, your homeowner's insurance premium that has to be paid in full for the first year. You would pay that either just before closing or at closing. You select the insurance agent, the provider. We need evidence, proof that you've secured coverage and that it is paid for the first year. Lastly, prepaid interest. The prepaid interest is the interest that you would owe from the closing date to the end of the month. So if you were to close on the 15th of the month, we would collect interest for 15 or 16 days, representing from the closing date to the end of the month. If you were to close on the last day of the month, which is fairly common, we would collect 1 day of interest. So that prepaid interest varies depending on the closing date. Lastly, the escrow account reserves, and we'll talk about escrow account reserves in detail. Escrow accounts, taxes and insurance are often collected as part of your monthly payment. So when you make your mortgage payment, the housing payment, PITI, the T and the I, taxes and insurance component of your payment, 1 month of taxes and 1 month of insurance is included in your monthly payment. So you're paying monthly to the servicer for taxes and insurance. The loan servicer holds those funds in an escrow account, and when the tax bill is due in Massachusetts, for example, it's typically quarterly. Each quarter, the servicer will disperse funds from the escrow account and pay the taxes on your behalf. So you're paying monthly through the servicer, and then the servicer would make that payment to the town or city. Homeowners insurance, it's usually an annual payment, so you're paying monthly into an escrow account. Each month, another month's worth of insurance would be deposited into the escrow account. So a year after you close, there'll be enough funds in that account for the servicer to pay the next year's homeowners insurance in advance, in full. So you're always paid in full for 1 year, at least 1 year on your homeowners insurance. Typically, we'll collect between 2 and 3 months of taxes at closing to fund your escrow account or to start your escrow account. That would be the escrow reserves. Homeowners insurance, not all programs require that insurance is escrowed in part of your monthly payment. It depends on the down payment. Generally, if you put 20% down or more, homeowners insurance is not required to be escrowed. Same applies to taxes. With 20% down, you have the option to waive tax escrow. And there are some programs with even lower down payments that do not escrow for insurance. PMI, private mortgage insurance, which we'll discuss in more detail, and flood insurance, if flood insurance is applicable, if the property's determined to be in a flood zone. Those items are always escrowed, regardless of the down payment, even if you put 20% down or more. PMI, private mortgage insurance. PMI allows you to purchase a home with a minimal down payment. It's required on most loans with less than 20% down. There are loans, no PMI options that are available for first-time buyers with as little as 3% down or 0% down, actually. So the PMI cost will vary depending on the down payment, whether it's 1%, 3%, 5% down, 10% down. As the down payment increases, the PMI cost decreases. So the rates will vary depending on the down payment. PMI is not forever. It will automatically be removed when your loan balance equals 78% of the original purchase price of your home. You can accelerate the removal once you have 20% equity in your home after at least the first year of making on-time payments. If you have 20% equity, let's say the value has gone up, you've paid down your mortgage, you've made your payments on time for at least a year. At that point, you can contact your servicer and ask what their procedure is to remove PMI. It's not required that they remove PMI, but they may. And if they do allow that, they'll give you the details on their requirements. If the property needs to be appraised, they may provide a list of acceptable appraisers. So don't go ahead and just order an appraisal. They may not accept it. Contact your servicer if you have 20% equity, and you may be able to remove PMI. But the key with PMI is it enables lenders to offer financing options with very low down payments. Many years ago, there was kind of one option, 20% down or more, and PMI many years ago was not available. The types of mortgage loans, generally there are two types, fixed rates and adjustable rates. An adjustable rate is just that. The rate can adjust in the future. So you're taking on some interest rate risk with an adjustable rate program. Typically, adjustable rates will be fixed for an initial period. So you, for example, on a 5-year adjustable, the rate is fixed for 5 years and then would adjust after year 5. A 7-year adjustable gives you more stability where the rate will be fixed for the first 7 years and then would adjust. A 7-year adjustable rate is higher than a 5-year adjustable rate. The 5-year adjustable rate is the riskiest for you. It has the most interest rate risk, so it is the lowest rate. And there are other adjustable rate options with longer terms as well, 10-year ARM, for example. Fixed rates, the most stable program. The rate never changes. It's a stable payment. The principal and interest payment will never change with the fixed rate. Your total payment, PITI, will change over time as your taxes and insurance increase over time. Your housing payment will go up, but the P&I payment, principal and interest, will never change. Versus an adjustable rate, the P&I payment in the future will change. There are both portfolio and secondary market programs available. East Cambridge offers both types of programs. I think it's very important to work with a lender that offers both of these options because depending on market conditions, interest rates may be lower in the secondary market. At times, portfolio rates are lower. Generally, portfolio underwriting guidelines are a little bit more flexible than the secondary market programs, but having both product lines is really helpful so that you will have full access to all the available options and you will be eligible for the lowest rate possible. For many years, the secondary market rates, for example, were the lowest up until the spring of 2022. Secondary market rates were amazing. The rates were in the 2s, the 3s, and those rates were lower than the portfolio rates. When rates increased dramatically through 2022, the portfolio rates are actually lower than the secondary market rates. So it does change depending on market conditions. And I think it's important to have access to all of the above options. So let's talk next about rates, points, and APR. The note rate is the rate that's used to calculate your payment, your principal and interest payment. The note rate or the contract rate is the rate that's that you'll see advertised. That's the lower of the two rates that you'll see advertised. There's a note rate, which again is what your payment's based on, and then there's the annual percentage rate, which is higher than the note rate because the APR reflects the cost of your mortgage loan over time, and it includes prepaid interest, points if you've paid points, closing costs into a single number for comparison of loan programs. Points can be paid to obtain a lower interest rate. 1 point is equal to 1% of the loan amount. Typically, that will reduce your interest rate by 0.25%, and that also varies depending on market conditions. Points are paid at closing, part of your closing costs. So paying points is definitely a long-term strategy. If you plan on owning the property for an extended period, if you think you will not refinance that mortgage within 5 to 8 years, paying points may be beneficial. But if you pay that mortgage off within 5 to 8 years, whether you sell the property or you refinance your loan, if rates improve and you refinance your mortgage, paying points would not be a good option because you won't have that mortgage long enough to recover the upfront cost of the points with that lower payment due to the lower rate. So I typically don't recommend points, but it depends on the situation. Everybody's situation is different. Time horizon in the property that you're purchasing is really important. But at this time in the interest rate cycle where rates are coming down off of the highs of last year, there is a greater likelihood that you'll have a refinancing opportunity over the next few years as rates are expected to improve. But we would look at all of these options and compare with you. So one of the options that is available that is a low down payment option for first-time buyers is the Mass Housing Partnership One Mortgage. The One Mortgage offers a discounted interest rate that it's generally the lowest interest rate available in the market for a first-time buyer. The minimum down payment is 3% on a single unit property, a condo, single family, or a two family. 3% minimum down. 5% down is the minimum for a three family property. For a three family, you must have at least 3% coming from your own personal funds. The other 2% or more can be from flexible sources, gift funds, down payment assistance. And with a two family, the minimum down, as I mentioned, is 3%, but the first 1.5% down must be from personal funds, but the other 1.5% can be from flexible sources, again, including down payment assistance, gifts, grants. A key benefit of the One Mortgage is there's no PMI, no monthly mortgage insurance. So you just have a mortgage payment plus your taxes and homeowners insurance, but no PMI. And that is a significant savings over the life of the mortgage. There is financial assistance available for low-income borrowers and some additional subsidies that will reduce your costs as well. As far as eligibility, as mentioned, this program is designed for first-time buyers. And a first-time buyer is defined as someone who's not owned a home within the last 3 years. So we will ask for and review the last 3 years' tax returns or tax transcripts to verify if you've had real estate holdings. And but if you are a first-time buyer, you would possibly be eligible for this program. There are some exceptions to the first-time buyer requirement as a single parent or a displaced homemaker. But in all cases, we'll look at the last 3 years. And but if you owned a property longer than 3 years ago and you haven't within the last 3 years, you're considered a first-time buyer for this program. There are income limits with the One Mortgage. They do vary by community and also household size. That's key, household size. So really anyone over the age of 18 who's earning income would be calculated or included in that income limit calculation. The income limits are updated annually, so they'll be changing soon. And if your income falls below the limit, you may be eligible for the One Mortgage program. And again, this is a hyperlink that'll take you to more information on the Mass Housing Partnership website. As far as the income limits, they have a couple different levels, 80% of the area median income and 100% of the median income. So for a single person household, the income limit is 114,000. For two wage earners in the household, it's 130,000, and so on. So having income under 100% of the area median income is key to being eligible for a Mass Housing Partnership One Mortgage. Borrowers below the 80% level may be eligible for that additional subsidy, which would lower your cost. There is an asset cap as well that has recently changed. Your household assets must be under 100,000. the liquid assets that are considered and included in that 100,000 calculation would be checking, savings, of course, any brokerage accounts, stocks, bonds, any gifted money that you may be receiving, Roth IRAs. Even though a Roth is a retirement account, it is the type of retirement account that is made with after-tax contributions and is included in this liquid asset calculation towards that 100,000 limit. The assets that are excluded would be all other retirement accounts, 401ks, 403bs, college savings plans, 529 plans are excluded as well. So 100,000 in assets or less is key for this program. As far as minimum credit scores, for a condo or single family, the minimum FICO score is 640. For a 2 or 3 family, it's 660. There are alternative credit options available for those who lack sufficient documented credit history. So we could use possibly a cell phone bill or utility bill that it's not reported typically on your credit report, but we can document your payment history to supplement the items that are reported on your credit report. And those types of utilities are good alternative credit options. A key thing to remember with the Mass Housing Partnership Program is there's no risk-based pricing. The rate is the same whether your FICO score is 640 or 840. So they do not adjust the rate based on credit score. And that's really helpful. And as I said earlier, the rates are discounted. This is one of the lowest, if not the lowest, first-time homebuyer rate available in the market. Another option is through Mass Housing Finance Agency. I know that both names are similar, not to be confused with Mass Housing Partnership. The Mass Housing Finance Agency is a different first-time homebuyer program. Very similar guidelines as far as 3% down being the minimum. Mass Housing Finance Agency offers a program with no PMI, just as Mass Housing Partnership does, but they also have programs that require monthly PMI. The Mass Housing Finance Agency programs include Mortgage Insurance Plus. So the MI Plus is a very helpful feature in some situations where if a borrower loses their job, MI Plus will pay the mortgage payment up to $4,000 per month for up to 6 months. So it's an additional insurance coverage that is included in the Mass Housing mortgage insurance program. So we offer at East Cambridge both Mass Housing Partnership and Mass Housing Finance Agency programs. Both are 3% down. Generally, the Mass Housing Finance Agency programs are a little bit more flexible. The underwriting guidelines are a little bit easier. The debt to income ratio, for example, can be higher than Mass Housing Partnership, and the income limits are higher as well. So we will assist you in determining eligibility for these programs. You may be eligible for Mass Housing Finance Agency, but not Mass Housing Partnership. We'll look at all the options to determine eligibility after a thorough review of your income and assets, and we can determine eligibility and review the different options with you. Next, let's discuss the loan estimate and the closing disclosure. The loan estimate is the initial estimate of your closing costs. It's based on the information known at the start of the process. It's provided to you within 3 days of application. And the loan estimate will break down the closing costs, the prepaid items, your monthly payment, and the estimated total funds needed to acquire the property. So it's a key document that breaks down all those items, and we provide prior to application a breakdown of all the costs and prepaids and monthly payments as well. But the official loan estimate, that's provided within 3 days of submitting an application. But you would have that same data, of course, before you apply, so you can compare programs and compare different lenders, because fees will vary from lender to lender. So that information is always provided to you in a written format for your review. The closing disclosure, that's the final accounting of your closing, which will detail the actual final closing costs, the prepaid items, prepaid taxes, prepaid insurance, escrow funds, and that is provided to you within 3 days of closing. You actually have to e-sign it at least 3 days prior to closing for compliance purposes, so that you receive that before closing. Gone are the days years ago when someone could go to closing and the fees might be different. That risk has been eliminated by regulations and providing this document prior to closing. Okay, next, let's take a look at the different types of pre-approvals that are available. If you'd like to get an idea of your eligibility without accessing your credit report, we can give us a call. We can do an informal pre-qualification, review your income, review your monthly payments that you provide to us, and give you an estimate of the loan amounts that you would be eligible for the different programs. So it's based on unverified information, just the information that you provide, but it'll give you an idea of eligibility for the different programs. A more formal process is the pre-qualification, which does require that we access your credit report, and it will include a review of your credit report. We'll review your income, assets to determine eligibility. We'll utilize an automated underwriting system software to determine eligibility for the different programs available: Mass Housing Partnership, Mass Housing Finance Agency, the other first-time homebuyer programs available, and we will issue a pre-qualification letter to you. The next step, and probably the best step if you're actively looking for a property or about to be actively looking for a property, a formal pre-approval is recommended. So pre-approval includes everything that we discussed as part of the pre-qualification, but it requires that we verify your financial information. So we would require your W-2s and pay stubs and bank statements, and of course your credit report. And one of our underwriters will review your application, review your supporting documents. They would then issue a loan decision, issue a pre-approval commitment letter, which is definitely a stronger letter than a pre-qualification letter. The pre-qualification letter is issued by a loan officer, whereas the pre-approval commitment letter is issued by an underwriter. So I think it makes a better presentation. When you do make an offer, the listing agent will see that your loan has been approved by a local bank, by an underwriter, a credit decision's been made, and that will give them a higher level of confidence in your offer and will improve the chances of being successful with your offer. You can apply online at our website for pre-qualification or pre-approval. But again, if you're early in the process and you'd like to just get an idea of what you're eligible to borrow, contact us. We do not need to pull credit. We can run the numbers, calculate your debt to income ratio based on the income that you provide, based on your monthly payments, and we can start to identify the programs that you're eligible for. A few things to remember. Consolidating funds into a single account is helpful. It allows for easier tracking of funds. It's less documentation. Large deposits. Any deposit or transfer into an account that exceeds 50% of your monthly income is considered a large deposit. So when the underwriter sees that or the loan officer sees that, they'll ask for the source of that large deposit. So we'll need, for example, the statement that the funds were withdrawn from. We'll need that account information to show where that money originated from that was deposited into your account. So please keep detailed records, copies of any large transfers, and we can easily document the movement of those funds. Where do you start? Work with experienced people. That's key. Find a local real estate agent that's experienced, someone you're comfortable with, someone that knows the market, and will be a trusted advisor in finding the right home that meets your criteria. As mentioned earlier, have your property inspected. That's really important so you're not surprised later with major expenses. The home inspection would be done after your offer is accepted. You would then inspect the property, and that inspection is done prior to signing a purchase and sale. So if there are any issues, you can address those with the seller as part of your negotiation to have the items repaired, or for the seller to lower the price, or provide a concession towards closing costs. There are different remedies if there are issues with the property that the inspector identifies, but please have your property inspected. I think that's really important. Using a real estate attorney, that's key. An attorney that specializes in real estate is recommended. Always have the purchase and sale reviewed by an attorney. They'll add language to protect you. They'll make sure that the document includes those necessary protections. You can hire your own attorney to review the purchase and sale, or you could use the bank's attorney, actually. The closing attorney can also represent you. And if you use the same attorney, the bank attorney, to review the purchase and sale, that will lower your costs versus hiring a separate attorney to do that. And lastly, get pre-approved with an experienced lender. Use a lender that has access to many different financing programs. Use a lender that's both a portfolio lender and a secondary market lender, and has access to both Mass Housing Finance Agency, as well as the conforming agency programs and other options as well. So using a lender that has full access to these programs is really key. That'll ensure that you find the best program that fits your situation, and you're getting the best rate. That's key. This is our contact information. Again, I'm Mark Simone. I'm a loan officer and manager here at East Cambridge Savings Bank. Laura Berg specializes in down payment assistance and grant programs and other functions here at the bank, as well as the other loan officers that are familiar with all these programs. We can assist. If you have questions, please contact us anytime. And we look forward to answering your questions and helping you in the future. Does anyone have any questions for us?
I don't see anything in the chat line. Anybody want to unmute and ask a question, or was this did you get enough information for your home purchasing endeavor?
I have a question.
Who
Yes.
is? I'm sorry, what was your name?
Mr. Patel.
Oh, Mr. Patel.
So the appraiser, how does somebody find out what the value is, or how do you know if the value is right? You know.
The appraiser will inspect the property, and they will find the most recent sales. They usually go back 3 months. They'll look back 90 days, find the most similar properties to the subject property, and they'll make adjustments based on square footage and the number of bedrooms, bathrooms, condition, location. But the appraiser will determine the value. And typically, in most cases, we see the appraised value equals the purchase price. Sometimes values could come in below the price, which potentially is a challenge. And sometimes the appraised value is higher than the purchase price, but the appraiser determines the value based on the recent sales, actual closed sales, not properties that are listed for sale, but actual closed transactions going back 90 days.
Okay. And if the purchase price is higher than the appraisal, what do we have to do?
If the purchase price is higher than the appraisal, if you're making a minimum down payment, the loan amount would have to be reduced. There are a couple remedies, but so let's say you're buying a property for $500,000 and you're putting 3% down, and the property is appraised at $480. Let's say it's the 3% down program, for example. The maximum financing on a value of $480 is 97% of $480, which is $465,600. So your loan amount would have to be reduced from $485,000, which is 97% of $500,000, to that lower loan amount. So if the price doesn't change, and that's the key, if the price doesn't change, you would have to make up the difference and put more money down. What we've seen most of the time, not all the time, but most of the time, when this happens, the value is lower than the price. The buyer will go back to the seller and say, hey, the value's lower than the price. I don't have the additional funds. Basically, you have two options. We renegotiate the price, or I have to withdraw my offer. And usually, not all the time, but usually, a seller will renegotiate, lower the price to keep the transaction together and not have to put the property back on the market. So I think it's actually helped. It's definitely stressful when that happens, obviously, but in most cases, it's worked out in the buyer's benefit. We've noticed.
Right, but sometimes when we are doing competing with other buyers over there, we really like the house or property, and we want to go a little higher than whatever the other person is offering because we want to get it. So in this way, we end up putting more money and even what they were asking, I guess. So now where does that leave us? Would it make sense to maybe get a little higher appraise, to a 500,000 in your scenario, and then put down 35,000? So now you have more down payment as opposed to having a 3% down payment.
Well, we would only do one appraisal. So if the appraisal should come in lower, and that does happen when the market was really very active and the market was very hot, we did see properties go under agreement above over asking. So when that happened, it was always everyone kind of was worried about the appraisal because the comparable sales might support a value of 500,000, but you've negotiated a price of 520. So in those instances, that's when we would see on occasion an appraised value come in less than the price. And if that happened, the buyer would either make up the difference because the loan amount would be reduced, or hopefully renegotiate with the seller. And if that couldn't happen, if either of those options weren't available, they would have to withdraw from the transaction if they didn't have the funds. But usually it worked out.
What if they did a non-refundable deposit or something like that? Like maybe $5,000 or $10,000 to buy the property.
Well, yeah, that's a good point. So in your purchase and sale, there'll be a mortgage contingency clause, and the mortgage contingency clause protects you. Think of that as deposit protection. So if for any reason your loan is not approved, your loan is declined, as long as you know and you notify the seller in writing on or before the mortgage contingency date, you would be protecting your deposit and would not lose your deposit. So the appraisal, the underwriting, that must be is completed prior to the financing date or the mortgage contingency date, so that if there is a problem for any reason, credit, employment, appraisal, your deposit's protected.
Right, but you kind of wasted like 45, 90 days or something like that because of all this transaction that's going on. And the seller is now out 2-3 months of thinking that he was going to sell, but he can't now. If you pull out at the last minute, where does it leave him or her?
Right. Oh, without a doubt, that's a risk that all sellers face. However, that mortgage contingency date's usually about 3 weeks after a purchase and sale is signed. So it would be off the market, yes, to your point, but it wouldn't be an exorbitantly long time that would cause unnecessary hardship for the seller. I mean, it's never a good situation, but that's why they
when
usually
you do an approval, let's say you do an approval or something like that. Let's say I'm approved for like 400,000, 500, or whatever the amount of money. Once you approve, like pre-approval or something, like you take my information, FICO, credit score, the work history, and everything, all the credits and everything like that, then you approve some X number. That approval, in my mind, I'm thinking that, I could buy a property over there under this amount and I should be able to close, very quickly because I have bank on my side, but it seems like when you have all these other criteria that you put on, it makes it difficult for us to go and, buy the house at $500,000, thinking that we're going to get it. And then now you have all these other criteria that you put on afterwards.
Well,
like, oh, give us this, give us that, and then this thing comes in now. So for us, when I'm thinking I have a pre-approval letter in my hand, I'm thinking, okay, it's just as good as cash or a check that I can just write and then be ready with, be done with it.
the pre-approval commitment letter is the strongest letter because essentially it's a letter that's subject to identifying a property, and appraising the property, completing a title search on that property. So with a pre-approval commitment letter issued by an underwriter, that's, as I said earlier, the strongest letter you could have, and that will make your offer as close to a cash buyer as possible. Certainly, a cash buyer is in a stronger position, but when a seller knows that you've gone through the full underwriting and it's subject to an appraisal, and if they're confident that the property is going to appraise, having a pre-approval commitment letter works very well. But yeah, it's definitely subject to an appraisal. So that's where there potentially could be a challenge. We haven't seen too many appraisal issues. The market's pretty strong. Properties aren't going over asking to the degree they were before. The market's cooled down a little bit. It's a little bit more in balance, depending on the price point, depending on the town. It's still a seller's market, but not to the degree it was before.
Right.
So it's definitely a much better environment for buyers now, especially now in the fall. I think the fall is the best time to buy for a buyer. In the spring, there's a lot more people, more competition, and inventory has increased a lot. The homes for sale, listed for sale, has been increasing, while the pool of buyers out there, because it's the end of the year and kids are in school and holidays.
Yeah, we are uncertain if the interest is going to go down now. So that's another problem, because if you get a higher interest rate, lock it in, and now the interest rate drops for like a quarter point to half a point next month or two, now you're basically, you're thinking like, okay, you lost a little money right now, or so it might be best to wait. We're thinking as a consumer, wait and see whether interest rates are going to drop, or it's saying it's dropping or drop. So having a pre-approval at a higher is not maybe beneficial. Like a higher interest rate, it might be good for the bank, but for the consumer, we may think that, okay, if it does go down, does your does a letter term sheet say that we can take a lower rate at that point, or if you're locked in, or then
Correct.
that's what the rate is?
That's right. When you have a pre-approval letter, the interest rate, this is a really important point, is not locked.
Okay.
So we'll assume a rate for underwriting purposes, but that's not locked. You're subject to the market. So if rates are higher in 3 or 4 or 5 months, whenever you have a property in the future, or lower, hopefully, you would be subject to the market rate at that time. So you're not
Right.
locked into a rate. And yeah,
Okay.
I think that rates are likely to be lower over the next few years. Obviously, there are many factors right now with inflation and economic growth and geopolitical events and
Yeah.
many
How,
different factors, but rates will
how
probably
long
be
is
lower.
how long is the term sheet valid for? Is it usually 90 days or 120, or can it be a little longer?
It's 90 days.
90 days. Okay.
Yeah, exactly. So that pre-approval or pre-qualification is valid for 90 days. It could be renewed every 90 days. There's no cost to renew the letter.
Right.
I've
So
had
we do that
customers.
like around 45 days, or like wait on the 89th day, because like, how does it, do you have to ask the bank is going to ask all this other documentation again, just when it comes down to the closer to the 80, 90 days? Or when is a sweet spot to try to get the reapproval? Like if we didn't find a property in 90 days, and let's say we are down to 45, 60 days or 80, do we ask for the extension already, or re-up the term sheet or something like that, or pre-approval letter?
Yeah, if you have a pre-approval commitment letter, we'll need to update your application with an updated pay stub, bank statements. If it's gone into the next year, updated W-2. We typically do that about 10 days prior to the letter expiring. So about
Okay.
80 days in, we
80
would
days, okay,
update.
yeah,
Yeah, we just update your file and
okay,
resubmit to our underwriter, and they'll issue the letter for another 90 days.
all right, good. And what's the turnaround time on that? Is it like 24 hours or?
It depends on volume. It's anywhere from 1 to 5 business days,
Okay,
depending on just our capacity at the time. We do prioritize. So let's say you're making an offer, you need the letter. That would be an accelerated process versus someone who is just at the beginning, they haven't found a property. So we can accelerate the turn time, but it's generally between 1 and 5 business
right.
days.
Do you recommend buying some properties in auction or something like that? Because I see some great deals on auction, but then they have to be rehabbed or something like that afterwards, you know? So,
It's a different set of challenges. The financing options will be limited if a
yeah,
property's in poor condition. Most of these first-time buyer programs, low down payment programs, are not available for rehab situations.
okay,
So we typically don't recommend it. Not to say that it can't be the right option for certain buyers, but it would limit your financing options for sure.
all right, great, thank you, I appreciate it. And the home equity line of credit, is that something that you cover here or somewhere else, another session?
We do not cover it here, but we do offer home equity lines of credit. And that's something the bank offers as well.
All right, very well, thank you, I appreciate it, yeah.
My pleasure. Thank you. Does anyone else have any questions?
Nothing in the chat line.
Okay, well, again, thank you everyone for joining us. We welcome your questions. Please contact us anytime. And thank you again. Have a good night.
Thank you. Good night, Mark.
you.
Thank you.
Thank you.
Thank you, everyone. Good night.
Good night.
Night.